Have you ever wondered what a stock is? Let's break it down with a simple and tasty analogy. Imagine a large, delicious pizza. This pizza represents a company, and it's divided into several slices. Each slice of this pizza or company is what we call a stock. Just like how you would buy a slice of pizza, you can buy a stock to own a piece of a company. The more slices you own, the bigger your share of the pizza, or in this case, the company. You become a part owner, sharing in the company's successes and failures. Whether it's a small slice or a large one, every bit counts. Each slice, each stock, represents your share in the company's assets and earnings. So when you buy a stock, you are buying a piece of a company, becoming a part owner. Now you might be thinking, why should I buy a piece of a company? Well, it's a bit like planting a tree. You nurture it, water it, give it sunlight, and over time it grows, bearing fruit that you can enjoy. Similarly, when you invest in a stock, you're planting a financial seed. By owning a stock, you stand to gain in two primary ways. The first is through dividends, which are like the ripe fruits your tree gives you. It's a company sharing its profits with you, just for being an owner. The second way is through capital appreciation. If the value of the company grows over time, the piece that you own, your stock, also increases in value. When you sell it, if it's worth more than what you paid for it, you've made a profit. So investing in stocks can be a way to grow your money over time. But wait, is investing in stocks all sunshine and rainbows? Well, not quite. Just like any venture, there are risks attached, and it's important to be aware of these before diving in. Imagine the stock market as a vast, unpredictable ocean. Investing in a company is like setting sail on this ocean in a ship. If the company thrives, your ship sails smoothly, and you could even find a treasure chest filled with profits. Sounds exciting, right? But here's the catch. If the company doesn't do well, it's like your ship is caught in a stormy sea. The ship could capsize, causing you to lose your investment. The stock market is unpredictable because it's affected by various factors: economic conditions, political events, market sentiment, and even natural disasters. One day you could be sailing on calm waters, and the next you could be caught in a whirlpool of market volatility. There's also the risk of falling into the trap of speculation, where you buy a stock hoping its price will rise, but instead, it falls. It's like buying a ticket for a cruise, only to find out the ship isn't seaworthy. And remember, there's no such thing as a guaranteed return in the stock market. Even seasoned investors can make losses. It's a game of patience, strategy, and resilience. So while investing in stocks can offer rewards, it also comes with its fair share of risks. Given these risks, how can you make smart investment choices? It's a question that stumps many, but the answer isn't as complex as you might think. The key lies in doing your own research. It's essential to understand that not all advice is created equal. What might work for one might not work for another. It's like trying to fit a square peg into a round hole. So don't be led by the nose. Be your own guide. A smart way to start is by investing in companies you already know and understand. If you're a tech enthusiast, technology companies might be a good starting point. If you're into fashion, consider fashion brands. Understanding a business can give you a better perspective on its future prospects. Now, while sticking to what you know is good, it's also important to diversify. Think of it as not putting all your eggs in one basket. Diversification spreads your risk across multiple investments. If one goes down, others might go up. It's a balancing act that can help stabilize your investment portfolio. Finally, remember that patience is a virtue in the investment world. Rome wasn't built in a day, and wealth doesn't accumulate overnight. The stock market is a long-term game, and patience often pays off. Remember, investing is not about following the crowd, but about making informed decisions based on your own research.